Hi, I'm Tyson Halsey, founder of Income Growth Advisors in Charleston, South Carolina. I've been on Wall Street for 40 years. I won the USA Today CNBC National Investment Challenge. I've been in the Wall Street Journal, Barron's, written over 100 articles for Seeking Alpha, and I've run a couple hedge funds. I think today's market mirrors the 2000 tech bubble peak and that large cap equities are overvalued. I also think bonds no longer offer the great returns that they did from 1981 to 2020 when inflation declined. We're in a deflationary period and interest rates declined in the 10-year US Treasury from 15.5% to 0.5%. In the 1990s, I ran a successful tech hedge fund, which got out at the market peak in March of 2000. However, in the years afterwards, I found it very difficult to make money, and that's because there was a great rotation. I believe the current period that we are in is analogous to the 2000 to 2011 period where equity markets were flat, but great returns were found in gold, oil, emerging markets, and that we have now entered an inflationary period where large cap tech will do poorly, but gold, precious metals, commodities, value, small cap, international and emerging stocks will do really well. And in the wake of the 2000 tech bubble, rotating into deep value commodities and geographies with solid fundamental stories worked extremely well because stocks and bonds are now fully valued. We think the 60-40 portfolio is overvalued and may even be obsolete. And for better income, value, and growth, we think people should consider a 25% US stock, 25% bond, 25% commodity, and 25% cash allocation. For retirement accounts, this is particularly important, as well as for retired investors. At the end of this presentation, we'll show a 7.5%, $2 million portfolio we put together for a Wall Street veteran. And we think this is a good example of how you want to rotate away from the 60-40 portfolio. Right now, I'd like to show you a couple slides. And this is our slide deck, the great rotation and market peak in 2025. Currently, we think that one of the best models for understanding valuation is the risk premium model or the Fed model. And this was developed by Ed Yardeni. And basically what it does is it compares the earnings yield of the S&P 500 to the 10-year US Treasury yield. Right now, it is almost negative. It was negative a few weeks ago. And it was definitely negative around the peak of 2000. And that was a great sell signal. We think that in periods where the US equity markets are overvalued, for example, where they are now with 22 times forward earnings, the historical return performance for the next 10 years tends to be rather disappointing. It's about 2 to 3%. We also think that the current market looks like a parabolic peak, not unlike the 2000 tech bubble. And here you have a comparison of the 2000 bubble peak to the current market. And in fact, the enterprise value of the Magnificent Seven today is 62% of the GDP. And that's extraordinary. To illustrate how expensive the U.S. market is, and the Mag 7 in particular, you've got a CAPE ratio, the 10-year cyclically adjusted ratio of the Mag 7 is at almost 60. And that compares to the S&P 500 at 33, which is historically where it's been in 1929 and in 2000 and in the late 60s, early 70s. But there are other places in the world where you can invest in equities. Argentina's around 1. You can invest in Brazil. You can invest in Hong Kong, China. All these places between 0 and 14, we think are much more attractive. Here's one of the problems that we have technically. The stock market has broken the 200-day moving average. Every major decline is preceded by a break of the 200-day moving average. We also think that the bond market that has been in a bull market for 40 years, 4 decades, declining inflation, a deflationary period, that ended in 2020 after declining from 15.5% to 0.5%. Now we have inflation, we're in the fours, but that's not really a great yield. We think that we've basically entered in an inflationary period, which is typical after stock market bubbles. And during those periods, you get gold and oil will do well, and emerging markets. And that's where we want to be reallocating our money. A good example of this is shown here. From 2002 to 2008, the emerging markets and the European markets did very favorably versus the S&P or the MSCI US index. Likewise, energy, materials, mining, industrials, they all did well during that 2000 to 2011 period. So here's the portfolio we put together for somebody. It has a 7.5% yield. We've got 25% in gold stocks. We have 25% in high yield and international bonds, 25% in closed-end funds and international high-yielding stocks. We have some money and some cash and maybe some shorts, depending on the individuals, kind of special situations, maybe 7.5% in MLPs. But basically, if you like what we're describing here and you want to understand our philosophy, you want help in terms of setting up a portfolio, go to our website, incomegrowthadvisors.com, and sign up for our monthly letter. Thank you very much. I'm Tyson Halsey.